Welcome to Skyrise Investments. You are watching the Market Mastery series, your journey from zero to stock market. In today's lecture, we are answering a very basic but extremely important question. What is a company? And what's the difference between a private company and a public company? If you understand this, half of the stock market starts making sense. Before we continue, if you are serious about learning the stock market step by step, make sure you like this video, subscribe, and turn on the notifications because every episode is built on the last one. First, let's understand what is a company. A company is basically a legal business entity that is formed to produce goods, offer services, and earn profit. It is separate from the people who run it. Meaning, if something happens to employees or founders, the company will still exist. This structure gives stability, trust, and scalability. Companies are of two types, private sector and public sector. First, let's begin with private sector company. A private limited company is a business that is not listed on the stock market. Its shares are not openly traded. Only founders, family, investors, or private institutions can own its shares. They do not require the same level of financial disclosure as public companies. For example, companies like Joho and Byju's are currently private sector companies. Private companies are usually in their growth phase and may become public later. When a private company becomes public, the process is called an IPO, initial public offering. Now let's understand a bit about public sector company. A public sector company is listed on the stock market and anyone, including you, can buy shares. Shares trade openly on stock exchanges. They must follow strict rules and publish financial reports. They have thousands or even millions of shareholders. For example, companies like Reliance Industries, Tata Motors, HDFC Bank, etc. Did you ever wondered, why does this matter for investors? A private company is like a business before marriage, only selected people are involved. A public company is like a business after marriage, where everything becomes public, regulated, and monitored. As a stock market investor, you can only invest in public companies because their shares are traded on the exchange. Understanding this difference will help you identify companies, IPOs, and long-term investment opportunities later in this series. To summarize today's lesson clearly, a private company is one where share ownership is restricted. Only founders, employees, or selected investors like venture capital firms can hold shares. These companies do not trade their shares publicly and are required to follow fewer regulations compared to public companies. On the other hand, a public company is listed on the stock market and anyone, including retail investors, can buy or sell its shares through exchanges like NSE or BSE. Public companies have thousands or sometimes millions of shareholders and must follow strict reporting rules, including publishing regular financial statements and disclosures. Private companies remain closed and controlled, while public companies are open, regulated, and accessible to common investors. If today's lesson helped you understand the foundation of the stock market, hit like, share this with a beginner or a pro. And comment "I'm learning" if you are following this series. Subscribe to Skyrise Investments, where we simplify the market one step at a time. And let's rise together.